You're welcome once again, ladies and gentlemen. As we have our breakfast, we'll be starting in a moment. So we try to convene in the boardroom and kick off the event. Going to be starting in the next 5 minutes, so let's try to wrap up and convene, please. So, it's actually three. So, is it? All right. Good morning, ladies and gentlemen, and very warm welcome to the Uganda Clays Limited facts behind the figures for the financial year ended 31st December 2025. My name is Isaac Kayemba, and I will be your MC today. So, in this room today, we have institutional investors, equity analysts, stockbrokers, and representatives from the Uganda Clays Limited, representatives from the exchange, members of the board and senior management. Honor to have them here today. So let's start. Let's humble ourselves for an opening prayer so that we can proceed. Heavenly Father, we thank you for this day. We thank you for the fact that you keep giving us energy to pursue our goals, to achieve, to strive for our country, our family, and the people around us. We ask you this day that you grant us the wisdom and the ability to engage, the ability to ask the right questions, and the ability to achieve success. We thank you for all the blessings you keep bestowing us, and we keep praying for your blessings. We ask all this through Jesus Christ our Lord. Amen. Amen. All right, on the agenda today, we will first have some opening remarks and welcome remarks from the CEO of the Uganda Securities Exchange, Mr. Paul Buiso. Let's give him a round of applause as he gets in.
Thank you, Isaac. Good morning, ladies and gentlemen. Welcome to the Stock Exchange. Today, we are holding a facts behind the figures for Uganda Clays. And so we look forward to hearing about their performance last year, the developments within the company, their strategy, and the way forward during this particular period. So I would like to welcome their board chair, Engineer, and their managing director, Mr. Jones Muhumza, company secretary, Mr. Matthias, and the board of representatives here present. So welcome and good morning. Allow me to speak to a few highlights about the market and its performance. Yeah. So just briefly, it's always important for us to speak about what's going on within the market, the performance of the economy, among others. As we are all aware, there's a lot of geopolitical tension within the different regions, and this has created a lot of global uncertainty and has resulted in some declines in not only currencies, but overall economic activity in some regions. But specifically, looking at the central bank benchmark rate, that remains at 9.75%, a level maintained since October 2024. Annual core inflation has averaged 3.83, and that was in 2025, but remains within the minimum target for the central bank, which is 5% and below. Core inflation has averaged 3.1% in Q1 2020. It was relatively stable, but we did see some run on the currency, 3.95% around March, as a result of the Iran-Israel-American war and the challenges around fuel. Treasury yields rose an aggregate 18 basis points across the yield curve in 2025. However, they've declined over 153 basis points in Q1 2026. And the headline Stanbic PMI averaged 53.7 in 2025, but has also seen in Q1 a positive 51.72, and that shows that there's growth within the economy over the period and positive signals. Moving to the market turnover, we've seen turnover in Q1 stand at 32.64 billion compared to 16.94 the previous period, and that is a 92.68% growth. We've seen growth in volumes of shares traded, 229 million shares. That's an 86.18% growth. We've seen growth in the deals on the exchange at 2,306. That's 6.41%. But overall, the one we really track is market capitalization, both for the all share and for the local. The all share stands at 42.63 trillion compared to 28 trillion the previous period. That's a 50% growth. And the local domestic capitalization stands at 21.77 compared to 14.46 the previous period. Overall, these are very positive signals and mainly driven by pricing on Stanbic and MTN, which have primarily driven turnover in on the exchange. Specifically, looking at performance by counter, MTN dominated at 64.7%, followed by Stanbic at 25%. Specifically, we've seen relatively low turnover on Uganda Clays, which we're speaking to today, 3.9% in terms of volumes, and stands at 42.5 million shares traded. So that's been the activity in Q1. I'll not specifically go into the counter performance. This presentation will be available. But speaking specifically to UCL, has remained relatively stable in 2026, despite a significant downside in 2025. And I think looking at the results, we should see some positives in terms of trading turnover and pricing on the Uganda Clays counter. Dividends declared year to date. We've seen a lot of, this is the season for financial results, and that's why we are here. So we've seen 7 out of 11 companies have declared dividends, and most of the companies have actually reported their financials. We must commend because the culture of reporting in a timely manner not only drives performance on the counters, but provides sufficient information to investors to invest in the companies, but also track the stock, the various stocks on the exchange. Our index continues to perform well this particular year, up 36.5% in 36.6% year to date in 2026, and the all share 22%. So positives from MTN, Bank of Baroda, Airtel, Quality Chemicals, where we've seen prices significantly gain and drive the local index. But if you also look at the comparisons, regional comparisons, we continue to fare well. I think we're the market leader within East Africa. No, we're the second compared to DSC, which stood at 43.1%. Their all share index was up 43.1. We stood at 36.6, and Nairobi at 11%, while Rwanda stood at 4.4. So overall, good performance and positive insights. On the fixed income market, treasury yields and the curve have decreased, as we mentioned, an aggregate 153 basis points post-election, which has led to a bullish market on the equities side. Because as interest rates drop, usually investors opt for the high risk equity investments. Total stock of securities in the market stand at 71 trillion. And overall, you can see that yields have had a mild change over the period between December to date. On the exchange, we've seen in Q1 12.8 billion traded in fixed income securities, driven by both the primary market at 5.6 billion and 7.1 in the secondary market. So the bond market continues to show significant growth, and this is majorly driven by retail investors on the exchange. So for us, as we look at it, it's quite positive to see the retail investors participate in the bond market. Number of investors on the exchange, CDS accounts stand at 275,000. Of the retail, we have 270,000, and the institutional at 4,800. Local nationals, those are Ugandans, at 259,000. And foreign nationals at 11,000. So it's good to see that the locals participating in the market, even though when you look at the turnover, the institutional drive the majority of the turnover on the exchange, and so do the foreign investors. But we've seen a positive from both the East African and the locals participating. So the analysis of Q1 accounts grew from 162 in January to 1,700, a 10-time increase over the period, driven by Crested Capital's physical drive and the USSD activation. Foreign investor base, as mentioned, has continued to grow, but that is with modest international participation in the market. So finally, in terms of performance of volumes, institutional drove 308 million shares traded, retail at 149 million, a total of 458 million shares traded. But in terms of value, institutional drove 47 billion worth of trades, the retail at 18 billion. And I think this is a positive insight in terms of showing the retail, the individuals really participating in the market. And that has resulted in a growth of 72.24 for institutional investors and 27.6%. So really positive insights in terms of trading. But in terms of the trades on the exchange, the net positive is that East Africans traded 19.63 billion. The locals sold 17.4. That's the local net outflow. And the foreign also sold 2.23 billion. Overall, it's good to see that the region is participating, and we're seeing more retail investors participate in the market, which drives growth and investment. I thank you for listening to me, and we look forward to hearing from the Uganda Clays team. Thank you. So I'll take this opportunity to invite the chairman of the board of Uganda Clays, Engineer Martin Kasekende, to make his remarks.
Good morning to all of you, and this includes those that are attending online. I want to welcome you to this meeting. The Executive Director, Uganda Securities Exchange, the shareholders and directors of Uganda Clays, brokers, the media, all stakeholders, I welcome you all to this session. Mr. Executive Director, thank you so much for your positive insights about Uganda Clays. It's one of those rare moments when Uganda Clays goes out there and gets some accolade. Really thank you very much for that. That shows you have been following how we have been progressing. As you are all aware, the results of Uganda Clays for the year ended 31st December 2025 have been published, and the acting managing director here will be providing highlights after these remarks. As evident from the results, the company has achieved a significant turnaround in its performance, as ED mentioned, from years of decline or even stagnation between 2022 to 2024, it has turned into profitability 2025. In the year 2025, revenue grew by 10% to Uganda shillings 34.8 billion, as opposed to 2024, which was Uganda shillings 31.6 billion. Profit after tax was enhanced to 140 million from a loss of Uganda shillings 4.95 billion in 2024. This performance and return to profitability is a result of substantial capex investment in the production process, the resultant improvement in operational stability, higher production volumes, enhanced plant efficiency, and cost management across key operational areas. In 2024, the board, together with management, developed and adopted a bold and forward-looking 10-year strategy anchored on 3 interdependent phases: turnaround, repair, and aggressive growth. The above gains as a result of the implementation of that strategy. The board and management are confident that they have turned the company around from declining or static performance to recovery and sustained growth and stability. The bad news, though, Although the company recorded a modest profit of Uganda shillings 140 million during the period as I've stated, the board of directors has not proposed a dividend for the year ended 31st December 2025 in order to preserve cash for the ongoing operational recovery, and preserving cash remains essential to financing Uganda Clays turnaround and capital investments plans. This proposal is subject, of course, to approval by shareholders at this year's annual general meeting, which is scheduled for 26th June 2026. I want to thank the Uganda Securities Exchange for hosting us this morning. I also want to thank the staff of Uganda Clays and our company secretary for organizing this event. I thank you very much for listening.
Acting Managing Director, Head of Finance, the opportunity to explain or give us more insight into the company's performance.
Good morning, everyone. I'd like to thank the Executive Director, Mr. Bwiso, and Uganda Securities Exchange for hosting us, the journalists, the investment gurus, and the brokers. Thank you. I will walk you through our performance for the year ended 2025, focusing not just on the numbers, but what is driving them and what they signal going forward. Good enough, our chairman highlighted on most of the key things, so I may not repeat myself. Starting with a broader context, the macroeconomic environment in 2025 was generally stable with modest improvement. Growth strengthened to about 6.3%, and inflation moderated to about 4%, supporting a gradual recovery in economic activity. However, interest rates remain elevated, with lending rates still above 18%, continuing to constrain the private sector credit and construction activity. What this means for the construction industry is simple. Demand is recovering, but cautiously. Projects are progressing, but financing remains tight. Growth is steady and not accelerated, and that's what we'd all want. For Uganda Clays, this translated into a market environment that was stable, but still price and cost sensitive. Against this backdrop, our performance in 2025 reflects a clear recovery and repositioning of the business. The top line grew by 10% to 34.8 billion, reflecting improved demand and better alignment between production and market trends. Our product mix remained anchored on our core lines, with tiles and markspans contributing over half of the total revenue. This reflects demand from individual owners, while markspans are a direct indicator of activity amongst the developers and large construction projects. This reinforces a key point that our growth is being driven by products with strong and consistent demand in the construction sector. More importantly, profitability improved significantly. Gross profit increased by 80% Earnings before interest and tax recovered strongly, and the business returned to positive earnings with a bottom line or profit after tax of 140 million from a loss of 4.9 billion in 2024. This marks a clear shift from the losses in 2024. Now, we'll ask ourselves what drove the recovery, and I'll take you through it. This was a combination of improved demand across our key market segments and a stronger internal execution. We saw steady recovery in both individual housing demand and developer-led construction projects, as earlier mentioned, which supported volume growth, while internally we enhanced efficiency and cost discipline. The most important factor was operational efficiency. We reduced production costs by 21%, driven by targeted interventions across most of the key cost drivers. This recovery was driven by a combination of improved demand across our key market segments and stronger internal execution, as earlier mentioned. At the same time, we strengthened how we operate internally with operational efficiency as the most important driver. Though targeted interventions across key cost drivers were reduced, we also saw the operational costs coming down and the production costs, and as a result, we saw an improvement in gross profit. We saw gross profit increase to 15 billion, up from 80%, from 26% to 43%, reflecting a much more efficient cost structure. Our earnings before interest, tax, depreciation, and amortization, which is EBITDA, rose to 8 billion, while our earnings before interest and tax rose to 4.6 billion, indicating stronger underlying operating performance. As a result, at the bottom line, the business returned to positive profit, as mentioned, marking a clear turnaround from the prior losses. From a returns perspective, key indicators improved, with the return on assets and the ROE and earnings per share moving from negative territory in 2024 to positive levels. This signaled a recovery in shareholder value. We also strengthened our cash position, generating close to 0.6 billion in free cash flow, while continuing to invest in the business, while capital expenditure increased to 6.3 billion. This investment was largely for sustaining in nature, or what we'd call strict sustaining capital, which is focused on current operations and improving reliability. That said, profitability remains partially constrained by finance costs, particularly related to legacy debt obligations. And here I'm talking about the NSSF debt that we all know. While operating profit has improved significantly, a portion of these gains is offset by these interest expenses that we incurred during the year, most notably from the NSSF facility, which continues to weigh on the net earnings. This is to note that it remains a priority area as we work to strengthen the balance sheet. From the operational perspective, we are producing more competitively. we are managing costs more effectively and maintaining a product mix that reflects market realities. Looking forward, our strategy is clear and deliberately phased. In the short term, which is turnaround, our focus is on stabilizing the business by strengthening liquidity, maintaining strict cost discipline, and ensuring a consistent and reliable operational performance across our two plants. This phase is about consolidating the gains we have made and building a solid foundation. In the medium term, we'll focus on strengthening through expanding capacity and unlocking value from the recently acquired Italian plant, which will enable us to scale production and enhance product quality. And in the long run, we'll drive sustainable growth by diversifying into broader construction products and offerings while exploring regional opportunities. The focus here is on building a more diversified, resilient, and future-ready business. Uganda Clays has moved from decline to recovery. The fundamentals are improving, revenues are growing, cost efficiency is stronger, and the business is once again generating positive earnings and cash flows. Our focus now is on disciplined execution, converting this recovery into sustained profitability and long-term shareholder value. Thank you, and I look forward to your questions.
Thank you, sir, for that very insightful presentation. So right now, I think we'll open it up for questions or Q&A. So anyone who has questions for the MD, for the board chair, or for the USC, we can put them forward at this moment.
Hello, good morning. Deogratius Wamala. I write for Daily Monitor. I have like 3 questions to the management of Uganda Clays. Could be maybe try to elaborate for us the operational capacity of the plants that you have and the sustainability of this recovery? Should the shareholders of Uganda Clays expect more dividends in time as the factory recovers, and also while the debt position declines? Maybe try to tell us the plan in the medium and long term. And to Uganda Securities Exchange, I have like 2. One is of the retail investors. I understand that we emerging economies like Uganda, we are struggling with patient capital, and we have seen offshore capital come and go in times of geopolitics. But like Uganda, we are seeing a revolution of retail investors coming in. And how important is that to the plans of our capital markets and financial markets? Because of recent, it's now, we're seeing more people, because at some point, even the financial institutions are struggling to have their, to pay for deposits because they are competing with guys that are investing in these securities. Maybe tell me how that is important and how you plan to grow this revolution of retail investors. Then the other to Uganda Securities Exchange is on this year we've seen more money rejected in the bond auctions, and we've also seen the yields decline. And the management of UCL has said that as the CBR remains tight, their cost of financing remains high. And that is something that we see overall in the manufacturing sector. So what do you think can be the best case use for this money put aside in these auctions? Because it's one that is chasing for yield, but at the same time, we are seeing that companies like these are also chasing for that cheap capital. Yeah, maybe that.
Yes, good morning. Thanks for the presentation, Jones. Mine is a brief one. Looking at diversification, I think that's something you've talked about since COVID on diversification. In my way, I interpret it in terms of products that we sell. Have you conducted any surveys, for people to tell you like this is the time you need to diversify? Just paint for us a picture since COVID. When you talk about diversification, what has really happened on ground? I stay in Chisasi, and I think there's a distribution channel. So when you're driving, you can see some of the displays there, and over the last 5 years, it has not changed in terms of the product they display. So give me a rough idea of what you mean by diversification. Thank you.
Thank you very much. Calvin from Crescent Capital here. I just wanted an insight into the business. We've seen the companies back to profitability, but what's going to push this profitability going forward?
Yes, so mine is also a quick one. Mine is on the dividends sharing. I just want more clarification on the shareholders. How are you going to? How do you usually work this out with the shareholders in not being able to declare a dividend, and how likely is this going to affect your future, potential investors, or how do you see that?
I think we can take those.
Okay. Thank you.
Thank you, moderator. And thank you, UBC. I didn't get your name. Mark. Mark, your question on dividends. I'll leave the other technical ones to the MD. Declaring dividends only occurs when you make profits. Once you don't make profits, obviously, there are no dividends to pass. But there's no subtraction of the shares because we have made losses. So they just don't get dividends when we have, and we normally declare that at the AGM, and we explain why that has happened. This time round, despite the fact that there's a profit, we still would not go ahead with declaring dividends because it is a very small profit which you need to plow back into the business. However, from what you've heard from the MD, the kinds of programs that they have on track, the only way forward is improvement. So given the fact that even the Q1 is showing a lot of positive results, there is all the hope that end of 2026 we'll be seeing a reasonable amount of profit, and going forward, those dividends, I think, will be declared, and I hope it will be positive with the shareholders and even investors waiting in line once that happens. I will ask the MD to continue with the rest of the questions.
Thank you, Chairman, and for the gentleman who asked all the questions. On operational capacity and insights into the business, I will take that as one question and respond to it. But most importantly, on operational capacity as Uganda Clays, what things have we done, and what are the numbers looking like, and what are we going to do? what we've done at the moment, and I mentioned it, is on ensuring that the plants we have are sustaining and sustainable in terms of production. We've seen paid up orders that were over 3 billion at any given moment, reduced significantly. And that is because on improvement on the equipment that where we've invested our capital. Last year we spent 6.4 billion in capex spend, and we're beginning to see the results. Production has improved significantly. The capacity of the plants, I would say, at about 80%, both plants now. Surprisingly, Kajansi is a much older plant as compared to Kamonkoli, but in terms of performance, they are at par. And this comes from a deliberate effort by Uganda Clays, the board and management, to ensure that we have that product available at any given time. Some of the things that we are looking at, obviously, other than operational efficiency, is growth, and that is growth of the top line, which is key. We talked about diversifying, which is what we are having. It's in the pipeline, but most importantly is getting to understand the market and the things that they expect from us. We want to give a whole and a total building solution as Uganda Clays. The different products that are out there, you all know them, be it ceramics, be it the clay industry and the space. Those are areas that we are looking at, giving you a total building solution. Other than growth in terms of production, volume, and quality as well, is expanding into the regional market. We are looking at getting into Tanzania. We had already gotten into Goma, which is DRC. That was before the war broke out. We're already in Kenya. We have an agent in Kenya. We want to actually get into South Sudan. But given the regional instability in some of these areas, we're a bit cautious getting into that space. We've had so many developers from South Sudan coming to buy our product, and we are seeing an increase in those developers from South Sudan. So we are cautiously looking at that and getting into the market. And key to our strategy is innovation, and it also relates to the diversification that I've already talked about. But most importantly is to keep innovating and providing solutions for our customers, not only in Uganda but the region. And with that, we should be able to expect an increase in the top line and the bottom line. What we are seeing getting into 2026, without getting into detail, is our performance actually being much better than what we are seeing, at least for Q1, and it's because of the deliberate and intentional things that as Uganda Clays, the board and management that are being carried out. Thank you.
I didn't get the second gentleman who asked about conducting surveys. I think it was out there. Yes. As you notice on the market, people are coming up with innovative finishes on the roofs. For example, I am now seeing roofing materials coming all the way from New Zealand simply because they have got color preferences. So yes, we conducted those surveys, and Uganda Clays is also adopting. It may not come this year, but very soon we should be able to move away from only producing brick red and producing what other people prefer, especially the youth would like uniqueness in what they are building. Others are moving away from roofs that sloped roofs into flat, going back to flat roofs, which is something that is returning. And Uganda Clays is not seated. They have the qualities which can go along with that kind of development. You can still finish with Uganda Clays materials, even if you go flat roofed. We are talking about floors. I know we've gone into ceramics, but people have now noticed that you can still get a very good finish with Uganda Clays quarry tiles in the flooring. So those are all results of surveys that have been carried out to see what are the preferences in the market. Thank you.
Yes, so Deo Gracious, your question on retail is quite important, and we believe that retail investors are very important in a market. Retail are the local Ugandans who participate in the market. Previously, our market was dominated by foreign investors, almost 94, 96%. And this is between 2020 to about 2022, 2023. So of the 32 billion we spoke about that was traded in Q1, 9 billion was traded by retail investors, 27%. So there's been significant growth from about 4%, and that was under 500 million. So if retail are trading about 9 billion, that's almost $2.5 million. It's really a positive insight that they now understand the market. They're willing to take risks. They're not only putting money in their savings, but they're also looking at businesses that have opportunities. So for us as the exchange, we look at it as a very good opportunity. And the more retail participate, the more activity we do have in the market. And it also creates stability, because retail trade more in the short end, short term, whereas institutions buy more long term, 3 years, 4 years to get a return. So positive sentiments, because we see more activity when retail do participate. Regarding the cost of financing, yes, as John's mentioned, it's quite high. And the benchmark rate is always the government bond rates. So if government is borrowing at about 15, 16%, that is very high. And of course, the banks or the lenders will also price over and above that. So seeing interest rates come down is quite important. And I think with the government not participating in auctions fully, taking less money as opposed to last year, is a sign that they will not pay highly for money lent to them. But also we've seen that I think there's a discussion of fast oil in Q4 this year. So they don't really need all this money at very high rates. So if government borrows at lower rates, we should see interest rates and private credit improve. And that will also drive the economy and participation in a sector like this. Thank you.
All right. Thank you, Paul. Thank you, Jones. Thank you, engineer. I think we'll take that one and then also read out some questions from the chat. We have people online, Microsoft Teams, YouTube, and the like. So I think let's have that first.
Check. I am Wampamba Nachibenge from NBS TV. Good morning. To Uganda Stock Exchange, Paul Buiso. Would the results as announced now have any effect on the performance of Q2? Just to give us an update on the products exchange, I'm one of the biggest consumers of the website details that are posted by the Uganda Stock Exchange every day. I used to see maize, but I no longer see it. What happened? Lastly, for a fact, I need to first admit that I know you're not CMA, but your unit trusts are growing day in and day out. SBG here will tell you that last year alone, they grew fourfold. managing assets under management of about 540 billion shillings. Is the performance of the unit trusts having any effect on the performance of the Uganda Stock Exchange as we speak? Many thanks.
All right, thank you. Let me read out just a couple of questions from the chat. We have Alan asking, I think he's from Kenya. Are there plans of cross-listing UCL to other securities exchanges, that is NSE and DSE, as a way of raising capital? And then on the issue of cross-listing, I think for the directors, possibly with the reduction in the use of traditional building materials due to modernism, have the management or board considered also diversifying to other clay products besides the ones they have at the moment? I think we've had a discussion on that, but expounding ceramic and porcelain tiles. And then the other question is on the loans, housing finance. So around the duration of that loan, is it long term, is it short term? And then the significant reduction in internal costs. What was bleeding the company before that has been cut out in 2025? So I think we can have those and then see any more.
Yes, just one question I forgot. My name is Ali Twaha from New Vision. I remember in 2025 there were discussions with Uganda Development Bank, to extend a loan facility for you to acquire some equipment in Italy. But on the debt structure I saw a housing finance bank, and we know very well that UDB, which is a shareholder in UCL, has the cheapest rates on the market. So I'm wondering, was housing finance the better in terms of the interest they are giving you, or rather the interest you'll be paying, was it lower than the agreements we're having with UDB, or just clarity on what happened really?
Thank you. So your question on results, yes, results do influence performance on the exchange and turnover. During this results season, investors look at the opportunities within the different companies, how well they've performed, have they declared dividends? As I mentioned, 7 out of the 11 have declared dividends. So this drives activity. So we do expect, and usually the best performing time of the exchange is usually in Q2, when results are being declared, dividend cutoff dates and the like. So we see a lot more activity during that period. So yes, we do expect to see an improved turnover in Q2. Looking at the commodities market, so commodities are seasonal, whether it's maize, beans, and the like. If you do recall, the grain that came out So the grains that came out in January, February were not good quality, with the smaller size, because so it's not that we put that on hold, but we've been reassessing how we work with the different partners, the cooperatives, the farmers, and the warehouses. So we took a step back to also look at how best to get contract financing, because exchanges generally drive what we call they guarantee both the buyers and the sellers in the commodities market, just like in the equities market. But if you don't have good quality grain, especially when you're speaking about the size, the aflatoxins, moisture content, all these have an impact, because to trade, you need a warehouse receipt that's backed by the security in the warehouse. Now, there's a lot of work we've been doing with the different players, UNBS, Ministry of Trade, the Capital Markets Authority, the warehouses, the guys who test these aflatoxins, and bringing this whole community together. Like we have brokers, custodians, the banks, the listed companies. It takes a lot of time. And also the seasons do matter. So what we've done is that we've changed our strategy, and we're working with both the contract side of it and alongside the financing. So we've been in a couple of talks with the banks, Centenary, DFCU, Stanbic, among others, to create a product that can help finance farmers, but also ensure that eventually gets traded. And that can provide a more lucrative but organized market. And as you know, as we sit here, maize is being traded in different forms. So the market is not as straightforward. So a lot of work we are doing. And one of them is we're also introducing what we call commercial paper, so that commercial paper can onward lend to the farmers. So a couple of initiatives there, but a lot of heavy lifting at this early stage that's required. So we still continue to drive the commodities market, but with a lot of background. The unit trust, yes, grew fourfold. I think it's currently at about 5.4 trillion in value. But I think the unit trusts have helped the exchange market grow, not only the bonds, but the equities. Because as investors get informed, that's another capital markets product. It's a collective product, collective investment scheme. Now, what we are seeing on this front is that as investors move their money from collective investment schemes, which we have players within the market, Old Mutuals, SBG, among others, they're also able to move that money to the equities because they're speaking to the same advisors. So for us, we believe that unit trusts have promoted, they've moved money from the short end of savings to the collective investment schemes and now to the equities market. So there's growth across the markets. Also, as the exchange, you'll be hearing soon about the ETFs we're talking about, the exchange traded funds, which are, again, a collective investment scheme, but traded off the exchange. So these are initiatives that will also drive further growth by aggregating units within the exchange different products. Thank you.
I should have introduced my director at the beginning of my speech. She's called Mrs. Marion Muyobo here, and on the board, she's very instrumental in terms of making sure that finances come. She's the chair of the finance committee. And Ali Twaha, your question, I think on UDB, I will ask her to give a response.
Thank you very much. So on, the question on UDB was asked that what happened in 2025 is so UDB. So at the time, our balance sheet was not attractive. So we are hopeful that we can go back to UDB and other financial institutions and ask them, because we still do need support. There's a lot of investment that has got to go into the plant. We have equipment that has to be installed. We do have some equipment that actually arrived. We have to install it. And there's a few more things that have to come in. And that's where the positivity you're hearing is coming from. There's a lot of work actually going on within Uganda Clay.
In use of our product that next 2 to 3 years. And we should expect significant growth in volume and product quality as well. Yeah, I think that's it.
ED, what has not come out in our submissions here, and I think for investors, this is very critical. It's a question that kept coming up all the time. We have a long-term liability, which we owe to NSSF. Do you call it a legendary loan that we obtained many, many years ago? But as we speak now, we are at least sure, and we have agreed with NSSF, that the way we are going, we shall be in a position to start offloading that loan in the year 2028. And there is an agreement we've signed for that. So that's no longer a constraint on our books because we had issues every time we asked for investors. Then that loan would raise its ugly head. What about NSSF? So, but now at least we're sure that that's no longer the problem because we have arranged, we've made concrete plans on how to pay back that loan, given what the MD has elaborated. MD, I hope you have an opportunity to introduce your team as well so that people get to know whom you came with.
Okay. Allow me to stand and introduce my team. These are the gentlemen, and I see one lady making things happen at Uganda Clays. Just over here in front of me is Simon Tumwebaze. He's our head of sales and marketing. And then Joseph Sendeger, who is the head of operations or the head of production at Uganda Clays. So all those beautiful products that you're seeing, that is the gentleman in the kitchen. Next to him is Mary Amujal. She's from finance. She was among the people who were able to prepare these reports in time. Like Mr. Buiso had mentioned, these are the people that are ensuring that you get these reports within the right time. Next to her is Mr. David Nahuera. That is our financial controller, and the man who ensures that these numbers are the right numbers and prepared according to the accounting standards. Thank you. Oh, and then there's Mr. Nalianya Matthias, our corporation secretary. Thank you.
All right. Thank you. A very good, thank you to the senior management, stars, the media, and we thank you for all those questions. And I think they've been answered exhaustively. So right on the agenda, which is going to be just two remaining events, ceremonial ring the bell event, and I'll call upon the UCL board and the USC management just to stand here so that we can have that moment. As the board chair and the CEO of the USC lead us in that, I think we can give a round of applause just to commemorate that. Lastly, after that, we'll be having photo moments. So you can stay behind to take a couple of photos for the journalists. So, okay, the team is going to stay this side. Not now, but I think as the bell is being rung, we can all stand up and give a round of applause.
We're back to lottery. Okay. Is there a count or just bring it loud and everybody clap? So are you ready for clapping? Yeah.
All right. Thank you very much, team. Thank you very much, our guests, for being such a lively audience. I think there's a backdrop at the entrance. We got us there. The journalists, the team from UCL, with the exchange team, and the board and